As we head into the weekend, the U.S. markets are closed, and it is a critical time to analyze the action in Toast, ticker TOST. The stock finished the week with an explosive move, closing on Friday, October 31st, 2025 at $36.14. This wasn't a quiet drift into the weekend. This was a statement. The stock rocketed up $1.75, a gain of 5.09% in a single session, and it did so on massive volume of over 11.7 million shares, well above its recent daily average. Now, the immediate expectation, seeing a chart light up green like that, is that some major good news is leaking, that the coast is clear. But the reality is far more tense. This move isn't a celebration, it's a high-stakes bet. Toast is scheduled to report its third quarter earnings on Tuesday, November 4th after the bell, and this 5% surge is the market placing its final wagers before the cards are turned over. This is the definition of expectation versus reality playing out in real time. The common belief for months has been one of caution. If you pull the chart back just 30 days, you'll see Toast has been in a painful slide, falling from well over $41 in mid-September. Analysts at major firms like Goldman Sachs and Keith, Bruyette & Woods have been trimming their price targets, moving them down from the 50s into the low 40s, citing valuation concerns and a tough macroeconomic backdrop for restaurants. So, the prevailing expectation was that the stock would drift weakly into its earnings report. Friday's 5% spike on heavy volume completely defies that narrative. This signals that a significant group of investors is willing to fight the trend and the analyst cuts, believing the pessimism is overdone and that Tuesday's report will be a powerful upside catalyst. This is the kind of pre-earnings volatility you often see in high-growth, high-profile names, not unlike the sharp moves we've seen in Tesla stock or Nvidia stock before their own pivotal reports. The options market is likely pricing in a huge swing, meaning this 5% move could be just the beginning, in either direction. Let's be very clear about what is at stake on Tuesday. This earnings report is not just about beating a headline number. The market is deeply divided on Toast, and this call will provide the data to settle the debate, at least for the next quarter. The consensus expectation is for earnings per share to land somewhere in a wide range, between 12 cents and 24 cents, with revenues projected around $1.59 billion. But experienced investors, whether they are managing a large Fidelity mutual fund or doing self-investing in an individual brokerage account, know the headline numbers are not the real story here. The reality of Toast's business is found in the supplemental data. The first number that will be scrutinized is annualized recurring revenue, or ARR, from subscription services. This is the core of the bull thesis. Toast isn't just a hardware company selling terminals, it's a software-as-a-service company. That subscription income is high margin and sticky. If that number beats expectations and, more importantly, if its growth rate accelerates, that will be a massive win for the bulls. It proves the model is working. The second metric to watch is gross payment volume, or GPV. This is the total value of all transactions processed through Toast's platform. This number is the ultimate health check on its customer base, the restaurants. Are people eating out? Are they spending more? If GPV comes in strong, it suggests Toast's clients are thriving despite inflation and economic pressures. But if that GPV number is light, or if its growth is slowing, it's a major red flag. It would signal that the macro environment is finally catching up to restaurant spending, which directly hits Toast's fintech revenue. Last quarter, in early August, the report was a mixed bag, a solid revenue beat, but a miss on earnings per share. That miss is why the stock has been treated so skeptically. This quarter, the company must deliver on profitability. The market has lost its patience for growth at all costs. Investors want to see a clear path to sustained positive net income, not just adjusted EBITDA. Finally, the entire report could come down to one thing: guidance. What Toast's management forecasts for the fourth quarter and the full fiscal year will be more important than the Q3 results. If they raise guidance, it could trigger a massive short squeeze and validate Friday's 5% rally. If they maintain guidance, the stock might tread water. But if they cut guidance, citing a slowdown in restaurant new openings or weaker consumer spending, Friday's 5% gain will be erased in an instant. This is a binary event, and it's why holding the stock over this weekend is not for the faint of heart. This is not the kind of stock you tuck away in a passive Schwab Intelligent Portfolios account and forget about. It's an active, high volatile holding that you'd be watching closely on a SoFi investing platform or the Robinhood app. Understanding this tension requires looking at what Toast actually does. The market expects it to be a simple payment processor, a competitor to Block's Square or Pfizer's Clover. The reality is that Toast has built a complete end-to-end operating system for restaurants. The hardware, the point-of-sale terminals and kitchen display systems, is just the Trojan horse. The real business is the integrated software suite: online ordering, inventory management, employee scheduling, payroll, and marketing tools, all bundled into a monthly subscription. This vertical-specific integration is its key advantage. A generic processor can't manage a restaurant's inventory or schedule its staff. Toast does. This creates incredibly high switching costs. Once a restaurant runs its entire operation on Toast, from taking an order to paying its suppliers, ripping it out is like performing open heart surgery. This is the bull thesis in a nutshell, and it's why a major institution like Fidelity Investments holds a massive position. They are betting on this sticky, integrated ecosystem. But this model has a dark side. The restaurant industry is notoriously brutal. The churn rate, the percentage of restaurants that go out of business each year, is high. This is a constant headwind Toast must outrun by signing up new locations faster than old ones close. Furthermore, the company is still fighting for profitability, and it trades at a very high PE ratio, making it look expensive compared to legacy tech or a blue chip like Apple stock. This is why the institutional ownership is so divided. While Fidelity brokerage accounts hold many shares, filings from the last few quarters show other big names like T. Rowe Price have been trimming their positions. The smart analysts are just as split as the retail crowd. Some, using platforms like Interactive Brokers to model complex cash flows, see a clear path to dominance. Others see a cash-burning machine tethered to a high-risk industry. This brings us to the future outlook, which hinges entirely on Tuesday's report. Let's outline the two scenarios. The bull case, what Friday's 5% jump is expecting, is that Toast reports a clean beat on all key metrics. Revenue exceeds $1.6 billion, subscription ARR growth accelerates, GPV shows no signs of a consumer slowdown, and, most critically, they deliver a strong EPS beat and raise forward guidance. If this happens, the analyst downgrades will look foolish, and the stock will likely gap up, breaking through resistance at 38 and beginning a new run towards its 52-week high of nearly $50. This outcome would validate the thesis that Toast is a premium, high-growth tech platform that is successfully navigating a tough economy. Now, the bear case, the reality check. In this scenario, Tuesday's report is a disappointment. Perhaps revenue beats, but subscription growth is slowing. Or maybe GPV is weak, proving the consumer is pulling back. The worst-case outcome would be a repeat of last quarter, an EPS miss, or even more damaging, a cut to Q4 guidance. If that happens, it confirms the fears of the analysts who cut their targets. It says the high valuation is not justified and that the macro headwinds are too strong. In that event, the 11.7 million shares bought on Friday will be underwater, and the stock could easily fall 10–15%, giving back all its recent gains. Many online investing sites will light up with red arrows. This is the risk that comes with online investing sites that make investing look easy. High-growth stocks carry high-growth risks. Speaking of the restaurant business, its health is at the center of this whole story. I'm curious what everyone watching has seen on the ground. Comment below with what you are seeing in your location. Are restaurants busier than ever, or are you starting to see more empty tables? Your on-the-ground view is a valuable piece of the puzzle. Ultimately, Toast is a story of a fantastic product versus a difficult market. The expectation is that a great platform must equal a great stock. The reality is that it must also do so profitably and in an industry that is famously unforgiving. Friday's 5% surge was the market's hope, a bold bet that the company has finally achieved the perfect balance of growth and profitability.